Welcome, deep divers. Today we're not just diving into a book, we're really excavating the very bedrock of modern financial thought.
That's right.
We're unearthing security analysis, foundations of value investing by the legends Benjamin Graham and David Dodd.
hmm
Just picture this. It's 1934. The world is, well, still reeling, recovering from the Great Depression, an era that just laid bare the dangers, the folly of rampant speculation.
A tough time.
Exactly. And into this crucible, Graham and Dodd deliver not some casual guide, but a really dense technical manual, a professional Bible, you could say, for serious investors.
Yeah, I wasn't beach reading.
Definitely not. And it's really crucial to understand that distinction because it's just so much more rigorous than Graham's later book, The Intelligent Investor, which is maybe more familiar to some folks.
And that context, it isn't just a footnote, is it? It's the whole stage. Security analysis isn't just a book. It is the foundational text. It basically rewrote the rules. It created the whole intellectual framework for what we now call value investing. So our mission here in this deep dive is to, distill its revolutionary insights, the timeless stuff.
Make it actionable for today.
Exactly.
Yeah.
Actionable for you. We want to cut through nearly a century of financial evolution and just pull out that core wisdom that's still so powerful almost 90 years later.
Giving you a shortcut.
A shortcut, yeah. A shortcut to understanding this seminal work without, having to wade through all 700-plus pages of pretty dense financial writing.
Okay, so let's unpack this right from the beginning. Because Graham and Dodd, they didn't just write a book, they drew a really clear line in the sand. They started with arguably their most fundamental distinction, investment versus speculation. Why was drawing that line just so critical then? And why is it still vital today?
Well, it's critical because it forces you to actually reckon with your own behavior, financially speaking. Graham and Dodd weren't just like giving definitions. They were drawing a moral line, a practical line, challenging the whole Wall Street ethos of the time.
Which was?
Well, mostly speculation back then, right? Investment, for them, isn't about hope or hype. It's cold, calculated. It's about safety of principle and getting an adequate return, and it has to be grounded in thorough, verifiable facts.
That must have sounded pretty radical in 1934.
Oh, absolutely. Especially when the market had just wiped out fortunes built on, well, nothing but speculative bubbles and predictions. It was a call for sanity, really.
Yeah.
A demand for intellectual honesty.
Right.
Speculation, by contrast, was basically anything else. Any operation where your return depends on market mood or chance or just guessing what the next guy will pay.
It really highlights that choice, doesn't it? Are you owning a piece of a business or are you just gambling on its price?
Precisely. The discipline in real investment is just paramount to them.
Wow. That clarity immediately makes you rethink a lot of what gets called investing today, doesn't it?
It certainly should.
So if speculation is out, what's our compass? What guides us? Graham and Dodd point firmly towards intrinsic value. Now, this is where it gets really interesting for me. What exactly did they mean by a security's true worth, and why is it so often different from the price flashing on the screen?
Yeah, intrinsic value is essentially the actual underlying worth of a business. It's derived from a really deep analysis of its assets, its earnings power, its dividend history, its overall financial strength.
Okay.
Think of it like a house. Its intrinsic value is what it would cost to build, the quality of the foundation, the structure, maybe the rent it generates.
Right, the fundamentals.
Exactly. The market price, though, that's just what people are willing to pay for it today. Maybe there's a rumor of termites, maybe a park's opening nearby. It fluctuates.
Market noise.
Market noise, exactly. Graham and Dodd teach us, ignore the gossip, assess the true structure, the real earning potential. And the key insight, the really crucial part, is that market prices often diverge from this intrinsic value, sometimes wildly.
Because of fear or greed.
Fear, greed, ignorance, you name it. But that divergence, that's not a problem for the value investor. That's the opportunity.
Oh.
It's about understanding the business itself, not just, its popularity contest in the market.
So intrinsic value is our guide, showing us the true north of worth. But how do we protect ourselves? I mean, our analysis isn't always perfect, right? The world throws curveballs.
Absolutely not always perfect.
Graham and Dodd give us that essential safety net. They called it the margin of safety, didn't they?
It did. And the margin of safety isn't just a nice idea. It's your indispensable buffer, your wiggle room, your financial insurance policy.
A wiggle room, I like that.
Yeah. It's the crucial difference between that intrinsic value, what you've painstakingly figured out it's really worth, and the price you actually get. You buy it for significantly less.
So you're building in a cushion.
Precisely. Why is it essential? Think about building a bridge. Designed for 100 tons, maybe? Well, with the margin of safety, you engineer it to hold 200 tons.
Just in case.
Just in case. Because maybe your calculations are a bit off, maybe there's an unexpectedly heavy load, a storm.
Or a bad CEO decision in investing terms.
Exactly. Or an industry downturn, or you're just slightly wrong in your valuation. It's your protection against the unpredictable future.
Yeah.
It reduces risk, not by predicting, but by providing that cushion against uncertainty.
Okay, so we've got the framework. Investment over speculation. Intrinsic value as the compass. Margin of safety as the shield. But who's doing this work? What kind of person did Graham and Dodd see as the ideal analyst? And what pressures did they warn about, especially back then, but also, today?
Yeah, they saw the analyst's role as one of huge responsibility, almost like taking a countercultural stand against all the speculation.
Standing apart from the crowd.
Definitely. It demanded objectivity, conservatism, and just unwavering discipline. At a time when many experts were just echoing the market, Graham and Dodd issued a powerful warning. Don't forecast based on optimism or trends.
Be skeptical.
Be deeply skeptical.
Yeah.
Especially of Wall Street enthusiasm and crowd psychology. They wanted analysts to be like diligent detectives, not prophets, trying to predict the future.
Focus on the facts.
Focus on the facts. Your job isn't to be popular. It's to be right over the long term by sticking to the verifiable realities of a business. It was, and honestly still is, a radical call for intellectual honesty.
That sounds incredibly demanding, almost stoic in a way. But here's a question. In today's markets, things move so fast, right? Disruption, tech shifts. Does that approach risk missing out on big growth companies that don't have those long, steady earnings records yet?
That is a really crucial question, and it gets to the heart of applying timeless principles in dynamic times.
Yeah.
Graham and Dodd, I think, would argue that while the companies change, human psychology and the basic nature of business value don't really change that much.
Okay.
They wouldn't say avoid growth entirely. They'd say avoid overpaying for growth you haven't seen yet.
Ah, the price you pay.
Exactly. Their principles demand that even with a fast-growing company, you assess its current strengths, its competitive position, its balance sheet, its demonstrated ability to actually execute, not just its exciting story.
So less about the narrative, more about reality.
Right. They'd likely advise extreme caution with companies valued only on narrative and potential, without any real current earnings or assets to anchor that value. Their framework doesn't block innovation, but it insists on a conservative valuation. It insists on that margin of safety against the uncertainties of change.
Okay, that makes sense. So building on that deep philosophical groundwork, Graham and Dodd didn't just stop at ideas. They showed how to apply them, right? They dedicated big parts of the book to the how-to.
The practical application.
Let's take a quick tour through the book's structure, because how they organized it is part of its genius. Starting with part 2, fixed value investments, bonds, preferred stocks. What's the main focus there?
For fixed value stuff like bonds and preferreds, the absolute core focus is safety. Safety of principal and reliability of those interest or dividend payments. It's not about hitting home runs, it's about preservation and steady income.
Getting your money back, plus a bit extra.
Exactly. They really emphasized the risk of loss, something maybe overlooked today. And they laid out these incredibly tough tests. First, earnings coverage. Can the company consistently pay its interest through thick and thin?
Not just in good years.
Not just in good years. Second, asset coverage. Do the assets actually back the debt if things go wrong? Is there a cushion? And third, past stability. Has the company shown resilience? Can it weather storms?
So history matters.
History matters a lot. The principle is crystal clear. In fixed income, safety always outweighs chasing a slightly higher yield. Always. A bit more yield means nothing if your principal vanishes.
A lesson learned the hard way in the Depression, I imagine.
Stark evidence, yes. Countless bond defaults proved why those tests were non-negotiable.
It's a sharp reminder that even safe investments need real scrutiny. Okay, next they move to part 3. Variable value investments. Common stocks. This is where many investors get tripped up, isn't it? Chasing gains.
Absolutely. Common stocks are where the allure of quick profits is strongest and where that line between investment and speculation gets really blurry.
Right.
Unlike bonds with fixed payments, common stock value is tied to future earnings power. But Graham and Dodd insisted it must be demonstrated power.
Proven power.
Proven power. They listed critical factors. consistent earnings records, not just a few good quarters, but over years. Seeing that operational resilience,
What else?
they scrutinized a dividend record and policy, not just the payout, but what it says about management's prudence. Balance sheet strength was huge for resilience. And understanding the company's competitive position, its moat.
Its advantage.
Its advantage, yeah.
Yeah.
And they warned strongly against overpaying for expected growth and getting caught up in speculative hype that inflates prices way beyond intrinsic worth. For them, a stock wasn't just a ticker, it was owning a piece of a real business.
Okay, so having defined what to look for, Part 4, Principles of Security Analysis, gets into the real nuts and bolts, the how. How do we actually calculate that intrinsic value? What methods did they suggest?
Right, this is the toolkit section. And it's critical because it grounds everything in tangible numbers. They outline several methods, but stress that valuation isn't about finding one single precise number. It's about establishing a range of value.
A range.
These include asset-based valuation, looking at book value, or even liquidation value, what are the parts worth. Then earnings-based valuation, focusing on normalized, sustainable profits, not just one good year.
Smoothing out the bumps.
Exactly. And dividend-based valuation, considering the stability and growth potential of the payouts. But the critical takeaway, valuation is not a precise science. It demands conservative assumptions.
Building in that margin of safety again.
Always. They believed in valuing a business on its past performance and current assets, then making reasonable, cautious projections, never wildly optimistic ones.
Now, what's really fascinating is where they go next in Part V. Special situations and opportunities. This sounds like where the really sharp investor finds those hidden gems, right? Things the market miss.
Precisely. This is where the truly diligent investor, the one who's mastered the earlier stuff, can find significant mispricings. Graham and Dodd saw these special situations as times when value gets obscured or just misunderstood.
Like what?
Things like reorganizations, mergers where the benefits aren't fully priced in yet, liquidations where the assets are worth more than the stock price.
Distressed companies, maybe.
Distressed or just deeply undervalued securities, yeah. And famously, the net nets. Stocks trading for less than their net current asset value, meaning just sell the current assets, pay the debts, and you'd still get more than the share price. These situations, and it's a big if they're analyzed carefully, backed by thorough research, they can offer exceptional returns because the market often just doesn't get it or lacks the patience.
So you're hunting for bargains where value is clear, but perception is skewed.
Exactly that. True bargain hunting based on rigorous analysis.
And finally, we get to Part 6, the conclusion. After all this dense analysis, the technical stuff, the practical application, what's the enduring message? The distilled wisdom?
Yeah, their conclusion is really this timeless testament to patient, disciplined investing. They hammer home that investing requires discipline, sticking to your principles when the crowd goes nuts.
Resisting FOMO.
Resisting FOMO, exactly. It demands patience, waiting, sometimes for years, for the market to recognize the value you saw. And it requires healthy skepticism, questioning every narrative, every trend, every expert.
Don't just believe the hype.
Don't. While prices will swing around based on emotions, intrinsic value is your rational anchor. Ultimately, they argue, long-term success comes from acting like a true business owner, not just a gambler betting on prices.
So, bringing it all back, what does this mean for you listening today? Here we are, nearly a century later, and security analysis is still seen as one of those vital finance books ever. Why does it still matter so much now?
Well, its legacy is just immense because it provided this robust intellectual framework that simply didn't exist before in the same way. It fundamentally shifted the focus from speculation, which, remember, was rampant, to disciplined, fact-based analysis.
It changed the game.
Completely.
Yeah.
And its influence, you see it through Graham's students, most famously Warren Buffett. He called it a roadmap I have been following for 60 years.
Wow.
This book really is the graduate-level manual for serious value investors. The Intelligent Investor is maybe the undergrad version, a fantastic introduction.
Yeah.
But security analysis is the deep dive.
The foundation.
It's the DNA of rational investing. And those core principles, they're immune to tech changes because they're about human behavior and business fundamentals.
So it really boils down to this, doesn't it? Security analysis isn't about predicting markets or timing the next big thing.
Not at all.
It's about the hard work, maybe the less glamorous work, of measuring value, demanding that margin of safety, and investing with discipline and patience, regardless of headlines or hype.
A call for intellectual independence.
Yeah.
Rigorous thought.
And on that powerful note, we've reached the end of our deep dive today. We've walked through these core tenets from Graham and Dodd's masterpiece. That vital line between investment and speculation.
Mhm.
Intrinsic value as your compass, margin of safety as your shield.
Essential.
Seeing volatility as opportunity, not just risk.
Wow.
And the ultimate triumph of discipline and patience.
Absolutely. And maybe a final thought for you to ponder. Just consider how easily the daily noise, the trends, all that information overload can pull us away from these fundamental truths Graham and Dodd laid out so long ago. How might applying their timeless insights actually empower you to think more independently, to cut through that noise, and make more rational, grounded decisions, especially when that siren song of quick riches is always playing?
A really powerful question to leave with. Thank you so much for joining us on this deep dive into the foundations of value investing.
My pleasure.
Until next time, deep divers.